Welcome to CFI's Real Estate Financial Modeling course. This is an awesome course where we're going to take a real estate development project for a townhouse complex and show you how to model it in Excel. We'll be starting from the basics like cost, construction, timeline, and loans, and turn that into a cash flow model so you can actually evaluate how much this development would be worth, all using Excel. You'll create charts, graphs, and a pro forma at the end that you could use to get financing, find investors, and sell this real estate development project. This course serves as a great case study on how to take your financial modeling skills to the next level with a real estate development project. As a financial analyst, you'll encounter all sorts of different industries, types of transactions, and types of models. So we want to expose you to as many different models as we can. This real estate development model will really take your skills to the next level as you model out in detail what this cash flow model represents. You'll look at things like internal rate of return, returns for different investor types, even make a cash flow waterfall that shows how every different investor in this project earns their rate of return. By the end of the course, you'll be much more confident in your Excel modeling skills and how to value a real estate development project. To complete this course, you're going to watch all the video lectures where we show you how to build the formulas and functions step by step. Then you'll do it on your own with your own Excel file, and you'll have the confidence to build this model from scratch. There'll be quizzes along the way and a final assessment at the end to make sure you really understand the most important concepts. This is one of the elective courses in CFI's Financial Modeling and Valuation Analyst program. It gives you a practical application of how to build a model for a specific industry, like real estate. So it helps you take your skills to the next level as a world-class financial analyst. In this chapter, we have several important objectives. The first one is to outline best practices when it comes to capital structure modeling in Excel. In this real estate case study, we will look very carefully at the capital stack and the funding of this project. We're going to discuss the characteristics of world-class Excel models. We're going to explain why you have to have all of the inputs and assumptions that drive the model clearly identified and located in one area to drive the cash flow and the ultimate output of the model. We're going to then discuss project finance and the various funding tools that are available for project finance, as well as explore the differences between project finance and corporate finance. Finally, we'll outline the real estate development process and a typical timeline, as well as the way of funding each of the stages in a real estate development project. By the end of this chapter, you should have a very solid understanding of what a good financial model for real estate looks like, what project finance consists of, and the typical timeline and process in real estate development projects. Let's review some important terms and definitions for the real estate industry. LTV stands for loan to value. That's the amount of money a lender will lend as a percent of the market value of a property. LTC stands for loan to cost. That's the amount of money that will be lent relative to the cost of a development. NOI stands for net operating income. It takes the gross rental revenue of a property, deducts all operating expenses, such as taxes, insurance, repairs, maintenance, CapEx, etc., and the net amount is NOI. The cap rate is short for capitalization rate. It takes the net operating income of a property and divides it into the market value of that property. The amortization period is the number of months or years that the principal on a loan will be repaid over. The term of a loan is the length of time that the interest rate on a mortgage is agreed for. GP stands for general partner, who is the owner in a partnership and has unlimited liability. They are also typically the manager and active in actually operating the project. LP stands for limited partner, and this is the passive investor who brings capital to a project, and their losses are limited to just the capital they've invested. A land loan is the financing that's required to secure a piece of land that does not yet have any net operating income being generated. FSR stands for floor space ratio, and it's a ratio of the land relative to the building area. It's used to measure or limit density on a parcel of land. GBA stands for gross building area. It's the sum of all building spaces measured from external wall to external wall. GLA stands for gross leasable area. It's the sum of all enclosed living spaces. GSA stands for gross site area. This is the measurement of the site area by its property lines. Deductions are portions of a site that may be excluded for certain calculations. It includes things such as public access, roads, and lanes, etc. NSA stands for net site area. This is the gross site area less any deductions that are noted above. The max GBA stands for maximum gross building area, and it's the largest building area that can be built by using the floor space ratio that's provided for the property. Construction GBA is equal to the gross building area based on the construction plans. And finally, the saleable area is the construction gross buildable area less all common spaces and other non-saleable areas. All of these terms and definitions are going to be useful when building our development model together. Let's look at an example timeline for a development project. Typically, teams start by sourcing deals. That means looking for opportunities, examining pieces of land that could be good sites to actually build these projects on. This could take a long time, and there could be many deals that are looked at until the most attractive or the optimal one comes along. Once that happens, then the development team can acquire the land. Once they've acquired the land, they may or may not need to rezone that land. If the strategy of the company is to get land and assemble multiple properties that then requires rezoning, this could take a very long time. If the land doesn't need rezoning, of course, it could be quite quick to move from acquisition into what comes after rezoning, which is pre-development. In the pre-development stage, a lot of the architectural plans, marketing concepts, and things are starting to be mapped out. And finally, from pre-development, the company can actually move into development, which includes the construction and actual building. The actual development phase may take some time, anywhere from 1 year on a small single-family project to several years on a multifamily or condo development tower. And then, once construction is complete, the real estate development company typically chooses to either sell, meaning to sell off all of the condos or all of the units, or to actually stabilize and operate the asset by renting out those housing units. Now that we have a general idea of the steps in the process, let's look at the funding and financing options along the way. So typically, a company will start out by looking for deals and having to fund that with their own equity. Since there's no actual land to back up any loans, there's no debt that can be used at this stage. But once there is a piece of land that can be acquired, then the land loan can actually be put in place and some additional equity may be required as well. Once development actually starts and even into the pre-development phase, then a construction loan can be obtained, and that construction loan will be drawn upon to finish the development, plus any equity top-ups that are required along the way. If the asset is sold, then everything is repaid, including the original equity. However, if the asset is going to be operated and rented out, then there may be some operating loans that go into place, and some of the equity will stay in the project as well. So this conceptual diagram will be useful when we're building our cash flow model for this multifamily development project. So what exactly is project finance? Well, in the simplest terms, it's the long-term financing of an independent capital investment. And what does an independent capital investment mean? It's referring to an asset or a project that can be easily isolated and distinctly identified with its own economics. Compare that to the general creditworthiness of a company that includes lots of projects and lots of assets. So unlike general corporate creditworthiness, which is corporate finance, project finance is just isolating a specific asset or project and those cash flows. That means that those cash flows from the asset or the project have to be able to cover all of the costs and the expenses and repay the financing associated with it. So it's all self-contained. Financing options typically consist of debt and equity or a combination of the two, and the duration of the investment is tied to the life of the asset. So for a debt investment, it would typically mature in or around the end of the asset's life. And with equity, the initial investment may actually be repaid and all of the capital returned at the end of the asset's life. Examples of industries that use project financing are mining, oil and gas, and real estate. All of these industries can identify assets that have specific cash flows and can have specific financing put in place for those assets and those projects. Now, let's compare what we just discussed about project finance with corporate finance. Corporations can undertake investments that use cash flows from other operating activities and other assets to fund their new ones. They can also issue debt with a general creditworthiness of the corporation as a whole, not a specific asset that they're borrowing the money for. And finally, they can issue equity with an indefinite time horizon, meaning that they are not necessarily going to repay that equity when the asset's life is over. The details of specific investments are also not as transparent to investors when that project or that asset is just a smaller component of the overall corporation. Let's look at an example of a capital stack for project finance. The most secure position, the first to get repaid, is the senior debt, and this typically makes up a large chunk, especially in real estate development projects. Then you have subordinated debt, which is junior to that senior debt. It would only get repaid after senior debt is paid and is, of course, more expensive. And then finally, the least secure but the highest expected return is the equity, which is provided by the general partners and the limited partners that are investing in the real estate development project. Now, when designing a capital stack for a project, there are many important considerations that have to be taken into account. Things such as the draws, the security, term, interest rates, and pricing. So the draws refer to the timing at which the capital will be used to fund the project. The security is your position in this capital stack, whether it's at the top, middle, or bottom. The term is the length of time that the borrowing will be outstanding. The interest rates, of course, could be fixed or floating, and then there's the pricing of equity that needs to be taken into consideration as well. So when we build our development model together, we will be taking into account the capital structure and the rate of return that is generated for different investors in this project. Let's quickly review some of the financial modeling best practices that we've covered in earlier FMVA courses. Models are always broken into three sections: the inputs area, the processing area, and the outputs area. The inputs are where all of the assumptions are contained, and they should be clearly identified using a color formatting and should all be easy to understand and easy to change. Then we've got the processing section, which contains our formulas, where we break down complex calculations into simple steps so that it's easy for other users and ourselves to follow the logic. Then we have the output section, where everything should be based on dynamic formulas so that the outputs always update. And we want to summarize the results with charts and graphs so it's easy for key decision makers to understand the analysis. In terms of formatting, we always want to clearly distinguish between inputs and outputs. We use a blue font color to represent a hard-coded assumption. A green font color represents a formula that's connected to another page or another worksheet. And a black font color represents a formula that just contains information on the same worksheet. So we will be using this color scheme when we build this real estate model together. And some additional formatting tips that we always recommend include using freezing of panes to include key information that's on the screen at all times, and you'll see examples of this in the course. We recommend removing the grid lines to make the worksheet look cleaner and clutter-free. It's important to set up a printable area so that if you convert it to a PDF or actually print a physical copy, it will look professional. And finally, you want to have consistent labeling across the tabs, including worksheet titles, descriptions, and units or other important labels. All of these concepts of financial modeling best practices are covered in our earlier courses, such as the Excel crash course and building a financial model in Excel.
Continue learning. Join CFI today.